All right, welcome to our latest Talk Tickers briefing. Today, we are tearing down the Q2 2025 earnings call for RB Global. They just dropped a really strong quarter and, the market noticed immediately. So what's behind the numbers and what's got investors feeling so good? Let's get into it. So let's start with the number that really tells you how the market felt. A 2% pop in the stock right after the earnings call. Now that's a pretty clear signal that investors didn't just like the results, they really like the story management is telling about the future. The real question is, what was in that story?
Okay, first things first, let's just look at the headline numbers. And really, this was a textbook example of a company that's firing on all cylinders and just sailed right past what Wall Street was expecting.
And it wasn't even close. Look at the adjusted earnings per share, $1.07. That blew past estimates by more than 10%. And revenue? Same story, a solid 6% beat. Sometimes you get a mixed report. This was not one of those times. This was a clean, decisive beat on both the top and bottom lines. But, great numbers are only part of it. The other, and maybe more important part, is the why. What are the strategic chess moves that are making this happen? And believe me, Q2 was a very, very busy quarter for them. Just look at this timeline here. In June, they make a big move in the UK to make their business less capital intensive. We'll get to that. Then in July, boom, they close a big acquisition, JM Wood, to build out their footprint in the US Southeast. And then in August, they turn around and give a 7% dividend hike to shareholders. So this isn't a company just sitting back. They are actively shaping the business, de-risking, growing, and paying back shareholders. Let's just double-click on that UK deal because it's such a smart move. They basically went from a model where they owned a ton of inventory, which ties up a lot of cash, to a much leaner, fee-based model. They keep the part they're best at, the high-margin salvage auctions, and spin off the riskier, capital-heavy parts business. What does that tell you? They're laser-focused on their core strength, running a super profitable marketplace. Okay, now if we dig a little deeper into the actual business segments, a really fascinating picture emerges. It was honestly a tale of two completely different markets for RB Global this quarter. You can see it so clearly here. On one hand, their automotive business was just on fire. Unit volume shot up 9%. They're just taking market share left and right. But then you look at the other side, their commercial, construction, and transportation business, let's call it CC&T, that side saw its total transaction value drop by 6%. And understanding this split is absolutely critical to understanding where the company is headed.
So you might be asking yourself, wait a minute, if a huge part of their business was down, how do the overall numbers look so good? Well, a huge piece of that puzzle is something called the take rate. Think of it as their commission, right? It's the slice of every single sale that they get to keep. And that slice got bigger. It went up by 20 basis points. That's a huge signal that they're getting better at capturing value from every transaction, which makes the whole business a lot more profitable and resilient.
Okay, so that brings us to the future, the guidance. After putting up such a strong Q2, management updated their outlook for the rest of the year. And the tone was, well, let's call it cautiously optimistic. And here's the update. They actually raised their forecast for profitability for adjusted EBITDA. That shows they're super confident in their ability to control cost and manage the business well. But at the same time, they guided the total value of stuff they expect to sell, the GTV, toward the lower end of their previous range. So what's that mean? In simple terms, they're planning to make more money on slightly less volume. It's all about focusing on high-quality, profitable business.
And of course, that was the million-dollar question on the analyst call. You can just imagine them lining up to ask, guys, you just posted a fantastic quarter. Why are you tapping the brakes on the outlook now? And the answer brings us right back to our tale of two markets. All of that caution is tied to that CC&T segment. Customers who buy big-ticket items, think construction fleets, transport companies, they're getting a little nervous. With interest rates high and economic uncertainty out there, they're kind of hitting pause. So management is just being prudent and reflecting that reality in their forecast.
So, let's put it all together. We've seen the results, we've heard the strategy, we understand the guidance. What does this all mean for the next earnings call? Well, here at Talk Tickers, this is our official prediction.
Our thesis really rests on three main pillars. First, that automotive business is a flywheel, and it is just going to keep on spinning, providing a super strong foundation for profits. Second, the weakness in CC&T, we think it's bottoming out. Now that negative 6% sounds bad, but if you strip out the one-time effect of that huge yellow trucking bankruptcy from last year, the segment was really only down 1%. That means the comparisons get way easier from here. And third, management has just proven they can protect margins no matter what the economy throws at them.
So here it is, our call. For Q3, we are expecting another solid beat, driven by that relentless automotive momentum. We think the stock will continue to grind higher, up towards those analyst targets in the $132 to $135 range, as the market keeps rewarding this kind of execution. So our rating is simple: outperform. The real question now is just how fast that CC&T business can rebound. If that happens, this story goes from good to great.
And that's our breakdown. As always, a quick reminder. This presentation is for informational purposes only. It is not financial advice.